Welcome back to Turning Hard Times into Good Times. We've got a disappointment. David McAlvany was scheduled to be our guest, but there's no David McAlvany to be found. And so I'm going to just pass along some of comments of my own to fill in the time here. It is always something I should be ready for because one never knows when, for whatever reason, guests don't show up. Over the 13 years that I've 11 or 12 years I've been doing this show, it's happened a couple of times, and most of the time the guests are there, but this time not so. In any event, I just want to maybe just comment a little bit on the markets from my perspective. It seems improbable to believe that the Fed can, that there's any way that the Fed can really tighten or start discontinue QE. They tried some time ago, and they tried to pull back the purchases of securities, and it didn't work at all. Immediately, interest rates started to rise, and the stock market tanked. And I think that we can pretty much expect that that is going to happen at some point here as we go forward. I might just, I have some of David McAlvany's, I was going to talk to him about his weekly hard asset insights. And David just talked about volatility that occurred the previous week. And then, of course, we had the soothing talk from Jackson Hole, and we had some very soothing talk from the Federal Reserve last week. In the end, when push comes to shove, the politicians and the central bankers always take the easy way out. And we've been taking the easy way out ever since Nixon took us off the gold standard in 1971. The easy way out, the military-industrial complex wanted to engage in wars and build the empire, but in order to do that, they had to pay for the they couldn't, the politicians couldn't tax Americans without losing their votes. And so they got the Fed. Nixon just unilaterally decided that he would just close the gold window, and so we were able to, with our military might, to restructure the petrodollar and go from there. But it was all based on taking the easy way out. Politicians wanting to get reelected, Americans wanting to have an easy time of it and not have to work and save. The free lunch, which is what human nature sort of wants us to, we sort of gravitate towards that if we're not disciplined and we don't recognize reality. I'm told here that we will be getting a call in from David. Okay, he is here then. Okay. Hi, David.
Jay, better late than never. Great to be back with you.
Okay. Yeah, thanks for joining me. Let me just ask you, I wanted to talk to you about your last weekly hard asset insights that I think people should really take advantage of. They can go to your website, the McAlvany Wealth Management website. And so it seems to me that it's impossible almost for the Fed to really start raising rates or to start discontinuing QE. What are your thoughts?
Yeah, certainly the talk is there because we've got inflation creeping up, and it's apparent to most of the folks at the Fed that it's something more than transitory, although that's all they'll admit to publicly. But the inflation issue is there. They'd like to raise rates, but you've got a financial system which is way over leveraged and dependent on the continued flow of easy money on very accommodative numbers. So I think you're right. I think it's going to be challenging for them to move away from that posture. As much as they'd like to, as much as it makes sense to, there's a consequence to doing so, and this is a price that they'll have to pay given the fact that they've kind of overstayed at this point way too long on the accommodative side of things.
Well, I don't know, way too long. As far as I'm concerned, David, they've been doing it for decades. And, I was just waiting for you to come on here. I'm a lot older than you. I'm closer to your father's age, and we remember the days when Richard Nixon closed the gold window. And we, as I recall, the U.S. was having trouble financing Vietnam. It was having trouble with the welfare state that was being expanded by President Johnson. And when Nixon come along, I mean, what were the politicians going to do? Raise taxes to pay for a war that people didn't understand? Were they going to raise taxes to pay for socialism? Wasn't a winning deal politically. So Nixon took the easy way out. Don't you think we've been taking the easy way out for generations almost?
We have. Inflation is one version of the easy way out, and now we've got a new version of that coming, which is financial repression. They've held interest rates low at an artificial level for a long time now. Following the global financial crisis, they've been held artificially low. And so you get kind of the 1-2 punch. On the one hand, you can't buy as much as you used to, as everything's costing a little bit more. And repression is this idea that you're also not getting the income that you expected off of the savings that you've set aside. And, that acts as a subsidy for those who are deeply in debt, including the government. So that 1-2 punch of inflation and financial repression, it is the easy way out. And, Keynes was not critical. I think it was actually complimentary of inflation, saying not one in a million people will understand what you're doing. And that's one of the reasons why it's a great policy. But great not for us, of course, but great if you're pragmatic and don't mind hurting your own people.
Right. From a political point of view, it's an excellent policy. And especially if you can keep them in the dark, down on the mushroom farm, as they like to say.
That's right.
So I'm just wondering, we have this prospect of if the Fed tightens too much. I mean, I was just remembering a few years back when the Fed tried to taper, and we had the taper tantrum. The markets, just a little bit of a tick up in interest rates seemed to wreak havoc on the markets and the financial markets. I don't know how many times I've looked at shorting the S&P 500, and every time I lose, because as soon as that starts to happen, it seems the Fed just juices the markets or gives some soothing words or whatever, and it doesn't. There's just no winning way to go to bet against the Fed. On the other hand, I mean, it seems like the only way to make money is just to go long in the stock market. What are the risks that we're facing there? I mean, after all, doesn't the Fed chairman have our backs if we're in the equity market forever? And what could possibly go wrong, David?
This is one of the reasons why we kind of pursue two different approaches in our asset management. One, we do have a short fund, and I can tell you it's not very fun when the markets move against you. So your risk controls have to be very clear, very tight, and you have to manage with a very disciplined skill set. So that's one approach. Our other approach is hard assets, where we want to own things that do, in fact, reflect the reflationary or inflationary trends. As you say, they've been in place for decades, but they've become more desperate in the last few years. And that I think is it includes precious metals. It includes global natural resources. It includes other assets that have an intrinsic value, and many of them, including real estate and infrastructure, also have cash flow. So you kind of get paid while you wait. What could be different, to the second part of your question, it's similar. What's different is the scale of things. I think of total margin debt versus GDP. And margin debt is, of course, what people are borrowing to speculate in the stock market beyond the money that they have. They're taking money from the house and adding to an existing position. They're that confident. And you tend to see margin numbers at their peaks when the markets are peaking. So no surprise that we had 1999 to 2000, margin debt got to about 2.5% of GDP. 2007, just before the market dropped 50%. Again, margin debt to GDP was about 2.5%. Now we're between 3.7 and 3.8% of GDP, the largest numbers we've seen in the history of the stock market. And, one of the things that's clear, we mentioned this in our comments on Hard Asset Insights on Friday, is that as you unwind leverage, it gets reflected in asset prices. And so we saw a decline of 4.3% in July from June, still sitting at about $844 billion in margin debt. But what could be different this time? I think it actually might be very similar to previous peaks, where you start to unwind a little bit of leverage, and then things get really interesting.
Yeah, I mean, it's like dominoes that start topping each other over. Yeah, you mentioned exactly that in your weekend missive. And people can go and catch that every weekend, can't they, David? If they want to read what you're thinking, it's yeah.
That's right. 2 things on the weekend. Credit Bubble Bulletin is on Saturday, as well as the Hard Asset Insights for a 1-2-page summary of what we see impacting the hard asset space, and very helpful. And it's meant to be brief so that you can go about your day. If you want a cup of coffee and the long slog, then Credit Bubble Bulletin will give you a good 15, 20 pages of data for the week. And the Hard Asset Insights is our attempt to put kind of 10 pounds of mud into a 5-pound sack.
And they can go to the McAlvany Wealth Management website, I guess, for that.
That's right. It's M as in McAlvany Wealth, M as in management, so mwealthm.com.
What are your thoughts on gold? I mean, gold, it seems to me gold is quite a bargain right now, because if you look at it relative to the amount of money that's been created, and with all this fiscal stimulus on top of that, and rising prices, but gold it's not been performing very well. What's your take on that?
Yeah, long term we're still very bullish, and short term you've got some technical hurdles to get over. We're trading below the 200-day moving average and well below a gap that needs to fill for us to see further upside in the near term. And so, I think, Jay, one of the challenging things here is that gold may trade against the dollar for a little while, and to the degree that we have any chaos in overseas markets, like we did a couple weeks back with, an unwind in Chinese credit, with Huarong and the asset management companies coming under intense pressure, required a recapitalization by the government. That impacted the commodity space. We had the dollar explode higher. Gold dropped like a stone. And those kinds of dynamics may still represent some short-term headwinds for the metals. And, I don't think it's a plug for the U.S. dollar. I think the fundamentals for the U.S. dollar are abysmal. But, on the other hand, it can in that short-term trading fashion, impact gold negatively. I wouldn't look at it from a standpoint of being concerned, because I think the long-term prospects, and I mean by long-term I mean 18 to 24 months, not long-term as in 20 years from now or something like that.
Yeah. Right.
In the long term, Keynes said we're all dead, so it doesn't really matter. But I think. Yeah, I think gold's prospects are strong. The gold-silver ratio is 77 to 79 in that range. I would own both. Looking at the miners compared to the metals, you've got the same kinds of ratios as we had back in the year 2000. So for the person who's looking for a bargain, I think there's definitely some really quality assets with some really quality management. And I think you got to pay attention to that too on the growth side. So actually, I'm encouraged by what I see. Just don't expect an immediate pat on the back by Mr. Market.
Okay. All right. We'll have to leave it go at that, David. I guess that's we'll try to catch up with you sometime when we have you for the entire segment. But it's good to hear from you in any event. Better than nothing, that's for sure. Thanks for joining us, and we'll look to do it again sometime in the near future, hopefully.
Thank you, Jay.
You bet.